So welcome everyone to this webinar on launch of banking and PSU debt funds by Trust Mutual Fund. Trust Mutual Fund is a part of Trust Group, which is more than 3 decades old, very respected group known for its thought leadership and financial innovation, particularly in fixed income space. So today from Trust Group, we have Mr. Sandeep Bagla, who is the Chief Executive Officer of Trust AMC and also the co-fund manager of this maiden debt fund, which is being launched under NFO, this Banking and PSU Debt Fund. And also, please uh, allow me to welcome Mr. Abhishek Dev and Mr. Neeraj from Trust Group, who are supporting Prabhudas Lilladher's sales team in promoting this Trust Mutual Fund NFO. So without much ado, I will hand over the dais to Mr. Sandeep Bagla, who is having 25 years of experience in investment management for various fund houses, primary dealers, and financial institutions. And he has been with Trust Group since 2014. And previously, he has worked with ICI Securities, Primary Dealership, AIG Mutual Fund, Reliance Mutual Fund, and Principal Mutual Fund. So with this, over to you, Mr. Sandeep, for taking us through this journey of the maiden launch, which is happening in the banking and PSU debt fund side.
Thanks a lot. Thanks a lot for those kind words and a superb introduction, Piyush. As was told earlier, we are an old group, but a new fund house, and most of the key people have spent enough time in the fund management industry. We are launching the first scheme, which is TRUSTMF Banking and PSU Debt Fund. Our NFO period is 15th to 20th January 2021. And I will take you through as to what are the key features that make us different from the other AMCs and other fund houses. So as you can see our logo has a pillar and a shield, which basically denotes strength, stability, and safety. So we believe in protection of the money, and we have also launched a digital campaign which says that protect the downside and upside will take care of itself. And we also believe in consistency. We have 3 words in our logo: clear, credible, consistent. Clear in terms of mandate, that at a point of time we will be staying true to the mandate of the investing asset class that we have undertaken. Credible, our investment process is credible. We have laid down the investment process into various steps, and we have taken various steps to make it more credible, as I will show you in the next slide. Consistent, we are focusing on risk-adjusted returns and consistency. Now, Trust AMC is a part of the Trust Group. Trust Group, while has been into equities and fixed income, it is more known for its fixed income activities, and we will also continue its streak of innovation and differentiated products in the AMC. Now, to jump right into the investment approach and what is different, our investment approach is very structured. Whatever we do will be research driven and back tested. One unique feature of our process is that we have tied up with CRISIL. CRISIL will be a strategic knowledge partnership for Trust AMC. This is the first time CRISIL has tied up with anybody on a plan like this. So first decision point is where to invest. We have decided to invest in AAA companies in the banking and PSU segment. Now, we believe that not all AAA companies are alike. So we will run our own set of unique filters along with CRISIL to identify our set of AAA companies in the banking and PSU space. I will take you through a process. I will take you through an example of how we do the entire process of selecting our universe. Also, then from the universe, we will create a model portfolio. In India, the fixed income indexes are based on liquidity. Globally, fixed income indexes and portfolios are based on outstanding. What it means is more the bonds issued by a company, the higher the weightage of that company in the index. In India, actually, that's not the case. Most of the indexes, rather all the indexes are based on pure liquidity. So whatever has traded more gets weightage in the next quarter in the index, a higher weightage. Ours will be a broad-based approach, which means that the model portfolio or the actual portfolio will be based on weightages on securities which are based on outstanding. So this is another differentiation from the existing practices in the fixed income markets in India. Why the portfolio is important is that there will be predefined limits of deviation in which the portfolio fund manager would have to create the portfolio from the model portfolio. So we are going to have predefined limits of deviation from the model portfolio, and within which the fund manager will create the portfolio. So while it's an active management, uh, it will be from limited active. There will be limits within which the fund manager has to approve. I am going to give you an example on that also. So this is called the Trust MF Banking and PSU Debt Fund. The fund managers are going to be myself and Anand Nevatia. Uh, Custodian will be HDFC Bank, and so will the fund account be. Registrar and transfer agent would be KFin Technologies. So what you get in this fund is a very unique method of fund management is called limited active. I have CRISIL, a portfolio of top rated issuers, a maturity of 3.5 years. So it will be a roll down fund. There is some amount of yield pickup in 3 to 4 year segments, and you can get 4 indexation benefits if you were to invest now and take out the money in April 2024. So the post-tax returns will be quite high. What has been happening in the markets, the bond markets, yields had come down in spite of inflation going higher, because primarily because people felt that inflation will eventually come down. Inflation has come down and is expected to remain within a range for the next 6 to 9 months. Going by the market behavior, I think the market believes that inflation will come down to close to 4.5 levels before settling down. There are large output gaps in the industry, in the economy today, and we believe that inflation should not be a problem going ahead. RBI has said that it will see through high inflation numbers in the short run. Market yields will go up only if people believe that RBI has lost control of the inflationary track and will not be able to control inflation in the future. In 3 to 4 year segment or in the 3 to 5 year segment, you can see that the term spreads are quite high by historical standards. And this we believe is a sweet spot on the yield curve. And this is where we are going to concentrate in. Just to give you an example, there are 155 companies which are rated AAA in the 3 to 4 year segment that we are going to concentrate in. However, we believe that we want to have a segment, a universe which is far more stable, and we want to identify the more stable AAAs from this. So, CRISIL, our knowledge partner, divides this group of 155 companies into liquid, semi-liquid, and illiquid. Now, illiquid companies are those companies where either the trading is very infrequent or the spread at which they are trading is much higher compared to other AAA companies. Now, without going into the reasons why spreads are high, we simply remove these companies which are rated AAA but are not being treated as AAA by the market. This leaves us with 86 companies only from 155 companies. We also, we call this the 4 filter approach. And the other 3 filters are that, companies should have stable rating outlook. Also, if there are multiple rating agencies, then even if one rating agency has a lower than AAA, that company is not a part of our universe. Also, that there should not be any rating change in the last 2 years. This gives us an element of stability in our universe. So while we started with 15 AAA rated companies, now we are left with 60 companies for the fund manager to start his work from. Now, interestingly, CRISIL also applied these rules or these four filters in the last 5 years. And we found that we had no exposure at any point of time to any companies which were rated AAA, but significantly were subsequently got significantly downgraded. Now, companies like ILNFS or DHFL or Reliance Capital, at no point of time did our universe have any exposure to any of these companies. So, in the worst period of credit contagion in India, our four filter method was able to protect the investor interests. There were some downgrades, single notch downgrades in the portfolio, about one downgrade a year in the last 5 years in companies like Bank of India, PNB, True Finance, where the market liquidity did not really dry up. Some of the companies, so 80% of the companies the fund would invest is our banking and PSU. There are only 5 banks which have made it past our filters, which are SBI, HDFC, ICICI, Axis, and Kotak. 10% would be in government securities as required by SEBI from 1st of February, and 10% would be up to the discretion of the fund manager. The fund manager could invest in 81 bonds of any of these 5 banks. To illustrate further the limited active methodology, so in the model portfolio, the weightage of PSU financial institution bonds issued by PSU financial institution is 30%. The fund manager can bring it down to 25 or take it up to 35. Now, this is done to ensure that the model portfolio structure is followed in the actual portfolio, and the actual portfolio is always a representation of the underlying universe. Similarly, in the model portfolio, there are 25 companies only, but fund manager can choose from any of the 60 companies in the universe and not beyond that. That is why we are calling it a limited active way of managing funds. CRISIL also backtested our returns for the last 5 years of the model portfolio vis-a-vis its own index, which is the CRISIL Banking and PSU Index, and also the average, the category average of the banking and PSU funds. And we found that our model portfolio has actually outperformed the category average by 100 basis points. So the fact that we had 81 bonds and also we did not have credit losses led to 100 basis points per year outperformance. Now this is not to be assumed that this is going to get replicated. This is not something that is likely in the future. Our idea and intention is to give returns commensurate with the underlying assets. None of the companies that we have spoken about or shown in this presentation are a recommendation to buy. This is the result of our internal or CRISIL's, which is who is our partner, their research that we are showing. Just to illustrate, the most likely, given the market condition, the portfolio yield of our portfolio is likely to be anywhere between 5.5 to 5.75. If one were to invest for 1 year and interest rates were to be volatile within a 50 basis point range, the range of returns could be 4.6 to 6.9, depending on whether interest rates go up by 50 basis points or come down by 50 basis points. Currently, liquid funds are yielding returns close to 3%. And even if interest rates were to remain volatile for a year, the fund is expected to outperform liquid funds. Also, the ideal investment horizon is slightly longer than 3 years to take the benefit of 4 indexings. Even if we assume a 5.5 yield and a 20 basis points of TER, the TER of 20 basis points is actually lower than most other similar schemes in the plan. If you assume cost inflation index at 4.5 for the next 4 years, we realize that post-tax return from the fund would be close to 5.25 or above. which compared to the tax-free bonds is actually quite high. Tax-free bonds today of similar maturity would be giving a range, a return in the range of I think 4.5 to 460. I think uh, I have already spoken about my credentials. I have worked in the fixed income departments or a head of bond trading for ISEC PD, for Reliance Mutual Fund, Principal and AIG Mutual Funds. Anand Nevatia has been there in the market for 17 years with the group. He has managed the debt PMS portfolio for the company and he is an astute bond trader himself. We will both be managing the fund. So basically, we have a diversified portfolio of top quality credit with high liquidity, with strong internal and external risk controls, reduced volatility and tax efficiency of returns. Something about trust. I think the introducer had already spoken about trust a bit. So I will just say that we have been among the top 3 to 5 bond arrangers in India for the last 10 years consistently. We are the only non-bank arranger to be in the top 5. We have mobilized large amounts of bonds and conducted some of the unique structures like that of UP Power Corporation, where we were able to raise 20,000 crores bonds for them through a unique structuring. For DL, we did the first CMBS transaction. For banks like Bank of India and subsequently other banks, we were able to introduce the Basel III compliant Tier 1 bonds. We did the certified climate green bond for the Hero Group. In terms of our asset management capability, while we are new to the AMC, we are at this point of time managing more than $3 billion worth of assets, 13,000 under our debt PMS or debt advisory. In equity advisory or equity PMS, we have more than 4,400 crores. This is a PMS which is not marketed in India through distributors, but we have participation from some of the largest universities and their endowment funds in the US. In our wealth management company is close to 10,000 crores now with the name of Trust Plutus. So all in all, we are advising or managing across different asset classes more than $3 billion worth of assets. The group is completing 20 years this month, and we have been awarded many awards and recognition. Some prestigious ones like IFR Asia Awards by IFR as the best bond house in 2014 and 17, the best bond advisor by Asset Singapore, BSE, NSE, Prime, Bloomberg, Thomson Reuters for various primary and secondary market activities. And now we are coming out with our first mutual fund offering, which is the TRUSTMF Banking and PSU Debt Fund. So I would now, I would like to hand over to Piyush.
Thank you very much, Mr. Sandeep, for this insightful session. And now, the floor is open for question and answers. So, dear participants, if you have any question, you can put that question in the chat box or the Q&A section, and we'll try to get it answered from Sandeep. So, Mr. Sandeep, on behalf of everyone, one question which generally, all our zonal heads, branch heads, and key relationship managers who are present right now in this webinar, they would love to understand is that in the back, because generally the understanding of debt market was not very deep earlier, and people used to think debt is very safe and there will be no losses. But after this incident which happened, this INFS and DHFL, and which resulted into also the situation which happened at the Franklin Templeton Mutual Fund, where a lot of debt schemes were frozen. So people have some kind of an apprehension towards understanding debt as an instrument and the kind of risk which basically happens through the instrument. So the methodology which you highlighted about the selection of securities among the universe of AAA rated buyers, the issuers, if you could just slightly give your some insights which can help them in framing their sales pitch in this regard while facing the
Sure,
customers.
sure, sure, sure. So, recently SEBI also has said that, do not only go as per ratings, because ratings are backward looking. There could be differences, there could be developments in the market Uh, and also the market sometimes are smarter and give you advanced signals. So you should take, fund managers should take signals from the market. Also, this is what SEBI had written recently. And we are doing exactly that. We are taking market signals that, just like a company in equity markets where the price to earnings ratio might be low compared to, let's say in FMCG, everybody is valued at 50 PE, but you have an FMCG company at 5 PE, then most likely that 5 PE company is a trap, that there is something wrong with the management and you should avoid investing in that company for long term. So it's a similar approach that we have taken, that if something is not being treated like a AAA, if the spread is too high, if the market is demanding a very high price for it to invest in it, that means we would rather wait before investing in those type of companies. So we want to have a situation where we avoid. See, in my mind, fixed income investments are for safety, are for maintaining the principal and earning an interest which basically beats inflation. Now, if we exceed that mandate and we try to deliver equity type returns, then that is very unfortunate because in India, we don't have a market, secondary market for illiquid, low rated debt. So unless you have that kind of low rated debt market, then investing in low rated debt while offering instant liquidity to investors is next to impossible. And I would feel that some of the accidents could have been avoided in the debt market uh, by simply following these rules. So I don't want to, really comment on what Franklin did, and we are taking steps to ensure that we are not caught on the wrong foot, and that we invest in liquid AAA companies which are able to beat inflation, and we have a unique method for doing that. There's a question from Rakesh which says, "Do you think interest rates will go down going forward?" See, there is an equal chance of interest rates going down. Right now, I think the market feels that inflation is going to stabilize around 4% after 1 year, 9 months to 1 year, which is why we are at 6%. One way to look at what the market believes inflation is going to be, that you take the 10 years yield and you subtract 200 basis points. So 200 basis points is the real return the market typically wants. So if you think that inflation after 1 year is going to be higher than 4%, then interest rates should rise. And if you think that inflation goes down below 4% after 1 year, then interest rates will fall. So I think given the fact that there are high output gaps in the industry today, and there are no inflationary pressures, like the wage inflation is not happening, and there is no pricing power with the manufacturers. So I don't think that there should be widespread inflation going forward. And I think the broad market is also signaling that inflation should be around 4% going forward. So I think, unless people start feeling that RBI is losing the plot and inflation is going to go up, I don't think interest rates will go up significantly. So I think they will remain within the range. I don't see major impulses for it to come down also, or it to go up right now. But as the inflation scenario unfolds, I think one should form a view on interest rates. So right now, I know it does not say much, but I would say interest rates are appropriate at this point of time.
Correct. And we have one question from Mr. Samir Shah from our Calcutta branch about how to differentiate between, say, your banking and PSU fund versus the other offerings in the market. Maybe some key USPs because it's a maiden NFO, and could people are just warming up to the trust brand actually on the client level.
So one question is, why not a difference between your fund and other existing funds like ICICI banking, PSU fund, etc. Why somebody would invest in your AMC? not similar. So, most people, Sunny, do not invest in only a single fund. They invest in a basket of funds. So even if your investors invest in banking and PSU, I'm sure they will do it in 2 or 3 funds. So, from what I have understood, the two largest funds are IDFC and Axis, and their maturity is now, I mean, I might be wrong, but they are close to 2.5 years or lower than 2.5 years. So the weighted average yield of the portfolio has gone below 4.5%. So there is no possibility of, full indexation benefits within a single strategy. In our scheme, one strategy of 3.5 years, you are getting the experience of full indexation benefits and high post-tax returns. And I would not suggest that you do not invest in any other fund. My suggestion would be that you give us some allocation, as we are going to be not the top performing fund, not the best performing fund. We are going to be a fund where you do not lose sleep. You do not feel that something will go majorly wrong with this fund because of their process. Our process is very strong, and we have a tie-up with CRISIL. And we are wanting to keep your investors and our distributors safe. So I think that is the reason why you should allocate to us.
Great. So Mr. Dinesh Kumar is asking a question that what can be average return on maturity? So Dinesh, if I correctly understand your question, you want to understand the returns. So returns will be approximately close to 5.5% pre-tax. And since we are getting the benefit of 4 indexations in 3 years time, so our post-tax returns could be in the range of 5.25 to 5.28%. And since this fund will be an open-ended debt market fund, so there's no question of maturity kind of a thing. You can come and go based on your goals. But yes, the fund will invest in the securities where the average maturity period is 3.5 years. Anything you want to add, Mr. Sandeep?
No, absolutely right. My only thing I would like to add is that since yields have gone up slightly in the past few days, it could be a few basis points higher than what was indicated.
And yes, I mean, one question from Mr. Rahul Sabarwal, that looking at the pandemic and the situation of a lot of corporate houses, especially on the cash flow side, if they feel any crunch, is it safe to invest in this current market scenario in terms of if any future issue comes with the debt securities which these corporate houses are issuing? It's a general question, not directly connected to the PSU fund, because you invest into AAA securities. But generally in the market, I think that's what Rahul wants to know.
See, I think now most of the fund houses has become uh, quite concerned about the portfolio quality. So I think wherever there are no legacy issues, I think it's quite safe to invest.
So, dear participants, if you have any other questions, you can put it in the chat box.
Sandeep, just one question from my side.
Yeah, Pankaj.
Yeah. So this the ideal time horizon for this scheme, you're saying it's 3.5 years, right? But
Yeah, little over 3 or 3 months, yes.
so like ideally someone should have that view, or someone have a view of 2 years, then also he can look at this fund.
See, it's an open-ended fund. So as long as you think that interest rates are going to be slightly benign and not go violently high, you should invest in this fund. So if you think, because there's some amount of steepness in the curve also. So even if you hold for 6 months, your returns would be much higher than liquid funds, because the bonds would have rolled down from 3.5 years to 3 years. So what was trading at, let's say, 5.75 would now sell at 5.25, thereby generating capital gains simply because the maturity has come down. So there's some amount of protection because the duration keeps coming down, and there's some amount of steepness in the curve. So unless you expect interest rates to really go much higher from here, one can invest with a lower horizon as well.
Great. I think uh, most of the questions have been asked and they've been answered also.
Yeah,
So,
Sandeep, just one question, Piyush.
Sure, sure.
One portfolio, we'll be keep having a portfolio of 25 stocks. That's what I understand. That's right.
That's a modern portfolio. Yes.
So around 25. So we'll be keeping that portfolio till like hold till maturity, right? That's what roll down strategy is, right? Or
So
you'll
limited
be
active
adding anything in between.
Yeah, limited active means that 25 of model portfolio stock 25 will be like an index.
Okay.
So our objective of the fund manager will be to achieve the return of that 25 stock model portfolio or to outperform it, and it will be a hold to maturity portfolio.
Great. So, dear participants, in these volatile times, it's always safer to diversify and have some good debt funds in the portfolio. And as discussed in the presentation, some allocation can happen to this fund because this fund believes in the consistency of giving returns with a very clear and transparent framework of investment process. And it's supported by CRISIL in this process. So, with this, thanks a lot, Mr. Sandeep, for sharing this insightful session. And thank you all the participants for your time. And I again thank the whole trust team, Mr. Abhishek and Mr. Neeraj, and also Pankaj from PL's MF division for the participation. Thanks a lot, Samir, and we'll definitely look forward in promoting your funds to all our investors till the NFOU.
Thank you, Piyush. Thank you, Pankaj. Thanks to everybody on the team. We look forward to working with you and your customers. Thanks a lot.
Thank you. Thank you.
Bye-bye.